Your bank gets your paycheck Thursday morning at 4 a.m., but won't let you touch it until Saturday. And during those 48 hours, they're making money off the delay. The direct deposit lands in your employer's bank account exactly when your employer says it does. The ACH system that moves the money between banks completes in under 6 hours. Your bank has already received and recorded your paycheck by sunrise Thursday. But the money won't show as available until Saturday at 9 a.m., and that gap isn't an accident. This isn't about waiting for checks to clear or money to actually move. Your paycheck already moved. What you're waiting for is permission to access something that's already sitting in your account. And the reason they make you wait is because federal law lets them, and because every hour they hold your money is an hour they can use it themselves. Here's what actually happens when your employer pays you. Your employer initiates the ACH transfer Wednesday night. The automated clearinghouse batches transactions and settles them overnight. By Thursday morning before dawn, the money has left your employer's bank and arrived at yours. The transaction is complete. The Federal Reserve has already moved the actual funds. Your bank has your $875 at 4:15 a.m. Thursday. But when you check your account Thursday morning, you see pending deposit, available Saturday. 2 full days away. The gap between received and available is called the hold period. And federal regulation, CC, the rule that governs how long banks can make you wait, allows them to hold ACH deposits for up to 2 business days. Not 2 days for the money to arrive. 2 days after it's already there. Banks don't need this time to verify the deposit is real. ACH transfers don't bounce like checks. The money isn't coming back. Your bank isn't waiting to make sure your employer's payment clears. They're waiting because they can. And while they wait, they're using your money. During those 48 hours, your $875 is in your bank's pool of available funds. They lend it out. They invest it. They use it to satisfy reserve requirements. It's generating returns for the institution. The number floating in the pending column of your account is making the bank money while you're blocked from touching it. This happens to 150 million American workers every pay period. If the average hold is 2 days, and the average direct deposit is $950 and the bank can make even 0.03% on that money in 48 hours, that's 28 cents per deposit. Multiply that across every paycheck twice a month. That's 84 cents per worker per month. Across 150 million workers, that's $126 million a month, $1.5 billion annually. The actual number is higher because banks make more than 0.03% when they use your funds. But even the conservative math shows you why they're in no hurry to change this. Here's the part that should make you angry. The ACH system has been near instant for a decade. Same-day ACH launched in 2016. The National Automated Clearinghouse Association built the infrastructure to move money in hours, not days. But banks kept the old hold periods in place. They upgraded the speed at which they receive your money and didn't upgrade the speed at which they release it. You're being held to a policy written for a system that no longer exists. Regulation CC was created in 1987, when checks were physical paper that had to be driven between buildings. The 2-day hold made sense when verification actually took 2 days. Now verification is instant, and the hold remains. When a bank receives your ACH deposit, their system knows immediately it's legitimate. The deposit is tagged with your employer's routing information, your account number, and a transaction ID that confirms the transfer completed. There's no ambiguity. They're not waiting on anything. They're just allowed to make you wait. And some banks have proven they don't need to. Chime and Varo and Current all offer early direct deposit, your paycheck up to 2 days before the official payday. They're not doing anything magical. They're just releasing your money the moment they receive it instead of holding it for the maximum allowable time. Traditional banks could do this tomorrow. They choose not to. The midpoint fact that breaks the whole story. Your bank has zero obligation to speed this up, even though the technology is already in place, because Regulation CC sets a maximum hold period but no minimum release time. So they'll keep holding your money as long as doing so remains more profitable than the risk of losing you as a customer. The system is designed to favor the bank at every decision point. The Fed updated some clearing speed rules but left hold periods untouched. Banks lobbied to keep the float window. Their argument was risk management. They need time to ensure funds are good. But ACH deposits from established employers are the lowest risk transfers in the entire banking system. Lower risk than debit card purchases, which post instantly. Lower risk than wire transfers, which they release same day for a fee. The risk argument is cover. What they're actually protecting is interest income. If you've been watching this channel, you've seen us pull apart one of these systems every week. The gaps between what banks tell you and what they're actually doing with your money. If that's useful, subscribe. Next, we're breaking down the overdraft loophole that charges you $35 for being short by $2, even when you have pending deposits that would cover it. The mechanics are even worse than this. Banks make an additional game out of timing. They process deposits after they process withdrawals. So if your paycheck is pending Friday and you have bills auto-drafting Friday, they'll run the bills first, overdraft your account, charge you the fee, then post the deposit that would have covered everything. You get charged for being broke while your paycheck sits in their system already cleared. This is legal. The order of transaction posting is at the bank's discretion. They say they process debits first for your protection, so important payments don't get declined. The actual effect is they maximize overdraft scenarios. Every major bank has been sued over transaction reordering at least once. They pay settlements and change nothing. Here's why the delay still exists in 2025. The banks make more money holding your deposit than they'd lose if you switched banks over it. That's the entire calculation. They've done the math. They know some customers hate the delay. They know fintech apps advertise early access as a feature. They've decided the profit from the float is higher than the cost of the customer churn. And they're right, because most people don't switch banks. Switching is friction. You have to update direct deposit info, move automatic payments, transfer bill pay setups. The average American has 14 accounts linked to their bank. Migrating all of that to get your paycheck 2 days faster feels like more work than it's worth. Banks know this. They've researched it. The pain point has to be catastrophic before people actually leave. A 2-day hold is annoying but not catastrophic. So it stays. The hold also creates urgency for fee-based services. If you need money now and your deposit is pending, the bank offers you solutions. Overdraft protection for a monthly fee. A line of credit. A cash advance feature. They create the problem and sell you the fix. Chime doesn't charge for early deposit because they're generous. They do it because it's a customer acquisition tool that costs them almost nothing. They're using the exact same ACH system as Chase. They just don't add the artificial weight. That difference in experience is worth billions in venture funding and millions of new accounts. The traditional banks could compete on speed. They choose to compete on inertia instead. Some credit unions release deposits faster. Not all, but many. They don't have shareholders demanding maximum yield on every dollar. They can prioritize member experience over float income. If your credit union still holds deposits 2 days, it's because they're mimicking bank behavior, not because they have to. Here's what you actually do. Check your bank's funds availability policy. It's in the fee schedule, usually page 9 of a PDF nobody reads. It'll say how long they hold various deposit types. ACH deposits from established sources usually say next business day or second business day. If yours says second, you're giving them an extra 24 hours for no reason. Switch to a bank or app that offers early direct deposit. Chime, Vero, Current, and about 40 others now market this as their primary feature. You're not getting paid early. You're getting paid on time. The difference is they release your money when they receive it instead of holding it hostage. Setup takes 15 minutes. The payoff is immediate. If you can't or won't switch, set up a buffer. Keep 1 week's expenses in checking at all times. That gap means you're never waiting on a deposit to clear to pay a bill. You're spending last week's paycheck, not this week's. The hold becomes invisible because you're no longer living paycheck to paycheck on a technical level. That solution shouldn't be necessary. You shouldn't need a cash buffer to access your own wages. But the system isn't changing fast, so you adapt around it. Avoid overdrafting during the hold window. If your paycheck is pending and bills are due, manually pay them after the deposit clears. Don't let the bank decide the posting order. Autodraft is convenient until it costs you $35 because the bank processed things backwards. Use Zelle or Venmo for peer payments instead of checks. Those settle instantly and don't create multi-day holds. If someone owes you money and pays by check, that hold can be up to 7 business days. ACH and payment apps skip that entirely. The 2-day hold exists because it makes banks money and costs them nothing. The technology to eliminate it has existed for years. The regulations that require it are outdated. And the only reason it's slowly changing is because fintech companies turned faster access into a competitive edge. Your bank has your paycheck Thursday at 4 a.m. They'll let you use it Saturday at 9 a.m. Those 48 hours aren't clearing time. They're profit time. And until enough people move their accounts to institutions that don't play this game, the incumbents will keep playing it. That's how the float works. Now you know what you're waiting for, and it's not the money.